everyone for joining this live webinar with Generation Mining. Good morning. Generation Mining is developing the largest undeveloped palladium project in North America. And this webinar is being hosted by Emerging Markets Capital. My name is Adina and I'm a head of business development and investor relations. And Emerging Markets Capital is a Hong Kong-based private mining investment firm. And we help Canadian mining companies to build strategic relations here in the APAC region with mining companies, mining funds, and off-takers. And just a gentle reminder that this webinar is for informational purposes only. And as I mentioned, today's webinar will be provided by Generation Mining. For those of you who are not very familiar with the company, Generation Mining is a Canadian mining and exploration company. It's listed on TSX with the ticker GENM, and it is focused on developing the largest undeveloped palladium project in North America. It's called the Marathon Project. And in Q1 2021, the company has published the feasibility study that shows 30% IRR and over $1 billion NPV in the base case scenario. And today from the Generation Mining, we have two speakers, Jamie Levy and Kerry Knoll. So Jamie is the president, CEO, and director of Generation Mining, and he has over 25 years of experience in financing and management of mining companies. Previously served as the CEO of Pine Point Mining that was acquired by Osisko Metals. And he's also a former vice president of Pine Tree Capital. And also we have Kerry Knoll, executive chairman and director, who joined us today. Over 35 years of his career, he co-founded several successful ventures, including Wheaton River, Thompson Creek, and Glencairn Gold. He's also a former editor of the Northern Miner magazine. So with this, I will hand it over to Jamie and Kerry, who can share the slides. And please, if you have any questions, just type them in the Q&A box you see at the bottom of your screen, or you can drop me an email to adina@emarcap.com. So with this, I will stop sharing, and Kerry, you can pull up your slides.
Thank you for the intro, Adina, and thank you all for attending.
Yeah, thanks, Adina, and all of your colleagues for setting up the meeting. We're going to talk a little bit about our company and the people and the feasibility study that we just released in March. And we're going to talk a little bit about palladium. I know some of you may be familiar with palladium, but some of you may not. So we're going to talk a little bit about that, and then we're going to talk about why we think that we're Generation Mining at this point in time is a very serious investment to consider. So we've got three main metals in the mine we're developing, and it's mainly palladium. We've got a little over 4 million ounces of palladium, and as you probably know, palladium is used to scrub nitric oxide and carbon monoxide from car exhaust. And we've also got a considerable amount of copper, and copper is, of course, a big element in the electric car. And lastly, we've got over 1 million ounces of platinum, and platinum is going to be a key element in the development of vehicles with hydrogen fuel cells. So recently in March, we came up with a 13-year mine life in our feasibility study. Shows an average of palladium equivalent ounces of 245,000 a year, which would make us the 7th largest precious metal mine in Canada. And that shows a base case IRR, and the base case is based on $1,725 palladium and $3.20 copper. And it's still got, at those prices, a 30% rate of return. And I think you probably only see about 10 or 15% of mining operations at the feasibility stage have an internal rate of return of 30% or higher. And in Canadian dollars, that's a little over $1 billion net present value. At more recent prices, that internal rate of return goes up to 47%, and the net present value doubles to over $2 billion. So it really is geared to the rising prices, and the prices have been rising. They're actually quite a bit higher than these currently. So it's a very, very robust project. Our capital cost 665 million Canadian dollars. We think that I'll talk a little bit later about where we think that financing is going to come from, and it produces just in the first 3 years 979 million dollars in free cash flow in three years. So well past payback, and we can produce palladium for an equivalent all-in sustaining cost of just over $800 an ounce. We use some of the best engineering firms in the business to do our feasibility study, especially G Mining. G Mining has built 4 mines for Newmont and 2 mines for Agnico, and they built the big Osisko Malartic mine. They did the big Detour Lake expansion about 5 years ago. So they're what they specialize is in big open pit mines, and so this is a perfect one for them. Jamie and I have been working together for a few years. We were already introduced, so I won't get into our backgrounds. More recently, we brought on Brian Jennings and Drew Anwell. Drew is one of the founders of Kirkland Gold and was one of the guys who built their mine for them. He was there for 8 years, and previous to that, he was a manager of several mines for Barrick and Placer Dome. So he's been around this precious metal business for a long time, and he knows how to build mines. Brian Jennings is a chartered accountant who used to be a senior vice president of at Ernst & Young and has managed many resource companies over his career. And I won't get into all the people, but we've also got a very strong team of independent directors. These people all work for large mining companies. Paul Murphy is the chairman of Alamos. Cash Almeger is the chief operating officer of Hudbay, which is a base metal company. Jen Wagner is a lawyer and senior vice president at Kirkland Lake Gold, which is a multi-billion-dollar company as well. Phil Walford is a reserve geologist who founded the Marathon Gold Company, which is on its way into production. So we've got a really strong independent board of directors. So location, of course, is extremely important in mining, both in terms of the country you're in, the jurisdiction you're in, and your proximity to infrastructure. So this is Northern Ontario, this is Lake Superior. These are all past producing or currently under construction mines. The big Hemlo Barrick mine is just down the highway from us. This is our project here. Magino here is under construction. Hard Rock here is under construction. Hart Gold Mine went into production about 2 years ago. This is the only other palladium mine in Canada. It's owned by Impala, the South African company. So we've got all this stuff going on, and we've got strong community relationships. The towns up in this part of the world want mining. The First Nations want mining. So it's really a great place to be developing a mine. As far as locally, the infrastructure we have, this is the Trans-Canada Highway, it goes all the way across the country, and it goes right through our property. There's an airport right on our property. There's a town just south of our property, and there's a very large power line that is being upgraded coming right through our property as well. So we've got all of the stuff we need here, right here locally, that we don't have to spend money to build or to buy. And we've got cheap green power coming on this power line. It's 100% carbon-free power that will be powering this mine. We'll be by far the greenest palladium production in the world. History of the project, it was owned by a bunch of different companies. Stillwater bought it 11 years ago for $118 million. They sold 25% of that to Mitsubishi for $81 million, and then put it on care and maintenance in 2014 when they realized that the low palladium prices rendered it uneconomic. Sibanye bought Stillwater in 2017 and acquired this property, and we bought it from Sibanye in 2019. So we've increased our interest to 80%. It's actually about 81% right now. Sibanye does have a right to back in. They can buy 31% for $206 million. We don't know what they're going to do. They have until July 22nd to make that decision. So these are just the parameters for the feasibility study. And by the way, this PowerPoint is on our website for reference if you want to go back and look at it. This is the breakdown of the metal production that we're going to have. It's a 13-year mine life. 58% of our revenue comes from palladium, and about 27% comes from copper, and the rest from the other metals. So it's mainly a palladium mine, but at higher copper prices, you know, Goldman Sachs is talking about copper going to $6 or $7 a pound. If that happens, then it's probably going to be equally a copper and palladium mine. Our CapEx, I think I mentioned $665 million. These are our operating costs. This is all for reference. The base case internal rate of return is almost 30%, and the payback is only 2.3 years. At the spot price, and this is a higher spot price than today, the payback is only 1.5 years. And that compares with some of the other palladium mines. There's only 2 in the world that are also at the feasibility stage, and their paybacks are something like 7 to 8 years. So we get our money back a lot quicker. And the reason for that is the cash flow in the first 2 years. We've got in excess of $700 million in the first 2 years. And these are all Canadian dollars, and which is more than the CapEx, and which is why we have the very, very quick payback. And the way we've designed the mine is to put the palladium up front. So we get 2/3 of the palladium out in the first half of the mine life. And the reason we're doing that is because we think that by 2030, electric cars are going to become more popular. Gasoline cars will be less popular, and therefore we'll need less palladium. And so it's better to mine it now and sell it now. And the way we've designed it, the copper is mostly coming out in the second half of the mine life. So we're going to be, and copper, of course, is very, very necessary for electric cars. So we're kind of mining into the consumption curve, palladium first and then copper later. We've also got these other 3 metals in significant amounts, and what's really important about this is that these metals are something that we can stream if we choose as part of the financing towards production. We've been actually getting several offers on streaming these metals and also the copper as well, and we're considering them. We have to wait and see what Sibanye does on their back end first, but if we're going to be going this alone, which is there's a good chance of that, then we possibly will be streaming some or even all of these byproduct metals. Just talk briefly about sensitivities. So the thing I love about this project is that I can sleep at night. I don't have to worry about what the palladium price is every day. Palladium price, as you know, is over $2,500 an ounce right now. If you go all the way down to $1,250 an ounce, we've still got a 20% internal rate of return, which is kind of my cutoff as to whether when you should build a mine or not. And the other thing I like is what copper does for us. At today's copper price, compared to the base case, this adds $300 million to the net present value. And copper is only a byproduct for us, and yet it can add 30% to the IRR. That's just at today's copper price. You know, as I said, Goldman Sachs thinks it's going up to $6 or $7. So copper could play a big role in our company's future. I'll just talk a little bit about palladium here. Palladium is used in catalytic converters. Depending on the car, it can be as little as 3 or as much as 9 grams per vehicle. And it gets rid of the carbon monoxide and the nitrous oxide. Nitrous oxide especially is a greenhouse gas, 300 times more potent than carbon dioxide. And the palladium loading in China and Europe over the last 3 to 4 years has been increasing. And that's those political moves are what have pushed up the price of palladium to where it is today. And now we've got India doing the same thing, and Brazil doing the same thing. And I'm reading that Indonesia is now starting to adopt the European rules. So they're trying to clean up these capital cities that are extremely polluted right now. And by adding a few $100s to the cost of a car, they can do that. And that few $100s, of course, is in additional palladium that gets added to the car. And this is the last 20 years of the palladium market. The first 10 years of this century, it was in huge surplus. because it wasn't used that much in cars at that point. And then as it started to get used more and more, it went into deficit. And these deficits were made up until about 2018 mostly from Russian stockpiles. The Russian government had been stockpiling palladium from the Norilsk mine for years, but they started selling into the market back in about 2010, and it was pretty much gone by 2018, and that's when the price of palladium started to take off. And these deficits are expected to continue. Johnson Matthey estimates the deficit in 2021 is going to be at least 1 million ounces, and if not more. And nobody's really willing to predict 2022, but we are expecting a bit of an explosion in car sales over the next 12 months from today. And then of course that's going to just chew up a lot more palladium, and we think it's going to stay in deficit during that time. And looking way ahead forward, we think that yes, electric cars are going to start to take over, but in the meantime, there's still countries that are increasing the amount of palladium you need in each car. So we think consumption is going up. The other thing that's happening is people are starting to drive hybrids more and more, and hybrids need a gram or so more palladium than a regular internal combustion engine. So there's another increase. So even with the advent of the electric car, and if electric cars get up to 15 or 20% of the world car sales, we're still going to see the palladium consumption in cars going up. And the other thing that's happening is palladium does wear out. So these catalytic converters wear out after about 10 years, and they have to be replaced. A lot of, it's like 38 states in the United States require emissions testing every 2 years for cars that are more than 5 years old. So when that starts happening again, that's yet again more palladium that's got to be consumed. And we were talking, just about whether electric cars are going to affect us. We don't think so. And the reason for that is these are metals that we produce. So this is copper, platinum, and palladium. So a regular internal combustion car today, at today's palladium price and at today's amount of palladium in a car, is about $651 a car, US dollars. An electric car today, the metals we produce is mostly copper, is $837 a car. A fuel cell is $1,600 a car, and a hybrid car is almost $1,000 a car. So whatever scenario happens in the automobile industry, this mine that we're building is going to be needed, and the metals that we have are going to be very, very profitable. So Jamie, why don't you take over from this part of the presentation?
Thank you. Here's just a couple of slides just to familiarize yourself with our project and some of our peer group that had recently been taken over in production or had sold at some point in time. But you probably know some of these mines at Detour Lake had an IRR of 12.5%. And we're just using this to compare it to what we have at a 30% IRR, which, Kerry had mentioned earlier. Spot prices obviously were closer to 47%. But as you can see, Malartic, which is the big Cisco mining that got taken over by Yamana and Agnico, only had a 25% IRR. And then some of the other ones, Cote Lake, which is just getting built right now, had a 15% IRR. Magino, which has just got permitted as well, is getting built as 20% IRR. And then the only comp that we know of is a Waterberg project, which is Platinum Group Metals. It's trades in Toronto PTM, and I believe it's PLG on the New York Stock Exchange, has a 20% IRR. And that's trading at about 3 times the market cap of what we have. So we're just kind of trying to compare us to some of our comps that are out there, and we think we fit fairly well, and we think we're pretty inexpensive amongst our peer group. And then the next slide is just another slide that I put together just to show our production. We can't really talk in gold equivalent because our predominant metal is palladium, but we just did on this slide here just to compare it. But we're doing almost 300,000 ounces of gold equivalent a year. Our market cap has gone up a little bit. We're closer to $140 million. But if you look at a Marathon Gold, which is about 2/3 of our possible production, they're not in production yet either. These are all feasibility stage. They're doing 173,000 ounces. So about 2/3 of what we're doing, but their market cap is about 4 times our market cap. So there's a little bit of a disconnect here. Maybe it's the palladium versus the gold companies, but we think we stack up pretty good against some of these guys. We're definitely the most inexpensive that's out here right now. And then just again, to show you where we are in the gold companies in Canada, precious metal companies in Canada, and we'd be seventh, so we'd be right between the Metal Line and the Rainy River. So it's a pretty substantial, obviously, size mine, doing 300,000 ounces a year, or just under a gold, or 245,000 ounces of palladium equivalent. So, we're happy we're here. We just need to tell people this is going to be one of the bigger mines out there. And I think Kerry had mentioned it before. We'll get into the timeline right now, but we believe we're the only copper company in North America, definitely in Canada, going through the permitting process, and certainly the only palladium or PGM deposit in North America going through the EA process right now. So, as Kerry mentioned, we're a relatively new company, and this is a slide which we still can't figure out. Our market cap is about 140 million, as mentioned earlier, and our MPV, the 80% that we have, are trading less than 20% of our MPV. The peer group is trading closer to 0.9. This slide's a couple months old, but as you can see, if we got re-rated to maybe 0.6, like platinum group metals, that would be a double or a triple from here. So we think we have some more room to get re-rated. We had a slide in here, which is the old Lassonde, the mining circle curve, and I think it's right after the feasibility study and the permitting. You're kind of in this penalty box. So I think once we get out there, market the feasibility study, and we start to get through some of the permitting hurdles, we'll get re-rated to, hopefully, 1 times NAV or whatever the comp is here, which is, I guess, 0.9 of NAV. So. Again, you want me to do the timeline here? So we talked about the timeline, some of the things that we've done. Again, this is a new company. We just took over the project at the beginning of 19. We closed it in the middle of 19. We put a PEA out in 2020. We got the feasibility study complete within 14 months. Within that time, we got a new listing. Starting in the fall of 2020, we started with the baseline test which was the start to our permitting process. We informed the government we wanted to resume what Stillwater had taken place in the past. Stillwater, up until 2014, when they put the project under care and maintenance, they spent, I think the number was around $40 or $50 million on the permitting. But they put it on hold, and when we took over the project from Sibanye, we resumed the permitting, and so we're hopeful that by if the government participates, which is there's obviously risk and permit, but we think that this had met sufficiency back in 2014. We're hopeful that we'll meet sufficiency again, and the government won't delay this project. So we're hopeful in the second quarter of 2022 we'll receive our EA. Within that time, we're going to start working on some of the provincial permits, which will be to knock down trees, and we can hopefully start construction on the third quarter of 2022. And that would lead to construction at the end of, construction starting at 2022, production or commissioning at the end of 2023, and commercial production in 2024. So just going back to that slide, as you can see, we've done everything very fast. Kerry and I, we like to move fast, and we get our team moving fast, and we think this timeline is certainly reasonable. We do have some lobbyist groups helping us in our capital, province and federal, to make sure that the politicians know that this is a green metal. They have designated our metals, PGMs plus copper, as strategic metals. So we're hopeful that the politicians will realize this is over $1 billion in tax revenue, about 1,000 construction jobs, 450 full-time jobs. And there's a saying in Canada, for every 1 job, it brings in another 3 jobs. So, Canada's been hit pretty hard, like the rest of the world, with COVID. This would be great sort of for Northern Canada or Ontario to get this mine up and going. So we're hopeful that the politicians won't slow it down, and we'll be able to meet that timeline of production at the end of 2023.
So I just touch briefly, we got a few more minutes here on our exploration efforts, and people want to know why we're exploring. Because we've already got a feasibility study done. The material we're exploring for is not going to be part of the feasibility study. We're hoping it'll eventually extend the mine life. So going back a few years ago, this rock was found on our property, and this rock, as you can see on the top here, graded 188 grams of PGMs, and that's about 200 times richer than the ore body that we're going to be mining, and it's also got 9% copper. Again, it's about that's about 50 times richer in copper than the stuff we're going to be mining. We don't know where this rock came from, so we're doing a bunch of programs to try to figure that out. Drilling, prospecting, doing all kinds of work on the property, and what we're hoping is that where we think that came from is, if you look at this chamber here, so if you imagine the lava coming up to surface in a volcano, This would be the pipe that it comes up in. And on its way up, every once in a while, if the rock is fractured, you get the heavy metals collecting in little pools. And our main zone, this is our main zone. So this is what it would have looked like as it was being formed like 1 billion years ago. And we're thinking that that rock might have come from a deeper sulfide pool that formed somewhere deeper down, and then in a subsequent volcanic eruption was ripped from the rock and brought up and deposited somewhere further up near the surface. So we're thinking that we're now drilling down towards that zone, and this is another version of the same thing you just saw. So this is the open pit we're going to be mining, and these are old drill holes that showed that this was ore. We're now drilling down here, looking for that sulfide, and we've been getting some pretty good results. They're not as rich as that rock we found. They're nowhere close, but they're much richer than the stuff we're mining up here. And so the idea here is to drill off a deposit deeper down, and then eventually maybe sink a shaft or do a ramp down to this, maybe in 4 or 5 or 6 years. So the second half of the mine life, as you probably saw, the grades and the production levels of palladium are much lower in the second half of the mine life. But if we can take maybe 2,000 or 3,000 tons a day at depth down here of much richer rock and supplement the lower grades that we're getting up here, we can keep that high level of production for the entire 13 years of the mine life. So that's what we're doing to see if we've got enough drill holes here to form a full ore body, and if we do, then we're in luck. And this mine not only is going to make money for 13 years, it's going to make even more money. And so that's the purpose of this drilling right now. We're also looking on other parts of the property. There's lots of it's a big property, several hundred square kilometers, and we haven't explored most of it. There's lots and lots of places where we haven't really looked at all because it's covered with overburden. There's soil on top, so you have to go around and dig deep and down to the bedrock and see if you've got anything and understand the geology. And then if it looks good, then you can drill and see if you've got something. And this is yet another representation of the same thing. So this whole thing this is the open pit. This is what we're going to be mining here. And this is where we're drilling. So we've got a couple of zones, and these are zones that we think that fed the ore into this ore body through volcanic conduits. And so we're going to be drilling here, this summer, and going to be drilling up to the north as well. So that kind of covers that. So that wraps up the presentation. We've got 141 million shares outstanding, trading around a dollar, just I think a little over $1 now. We've got some pretty smart shareholders. We've got Eric Sprott, Lucas Lundin. They're both billionaires from the mining industry. Sibanye, who's the biggest platinum company now in the world, owns 8% of us. Osisko Mining, a very successful mining group here in Toronto. Again, they own 4% of us, and the officers and directors own 6.5% of the company. So I think we can turn around and open this up to questions.
Yes, thank you, Kerry. Thank you, Jamie, for the interesting presentation. We have received a number of questions. So let me start. I saw the recent drill results. I would appreciate a bit of speculation on the potential ultimate size of the resource and what is needed to get there. How might this change the economics of the project?
Okay, that's an interesting question. We can't speculate on the size of it because we're not, it's very early days, and this thing clearly goes down a lot deeper into the earth. So, but I can tell you what our target is. Our target is to get 3 or 4 million tons of 4 or 5 grams palladium equivalent. We're mining a gram, just slightly over a gram in our open pit. So if we can supplement that with maybe 1 or 2 or 3,000 tons a day, we're currently mining 25,000, planning to mine 25,000 tons a day. If we can add 3,000 or 4,000 tons or some number like that of higher grade material coming from an underground deposit and supplement that into the main mill, we'll be able to increase our production by 10 to 20% for very little money. And so, because the mill will already be running. So that's our goal with the drilling we're doing right now. The drilling we're doing on other parts of the property is to try to find other higher grade open pit deposits. Right?
And just to follow up, Kerry, there's a deposit that Kerry had mentioned that Impala took over from North American Palladium at the end of 2019, and they're mining underground, and their palladium equivalent grade is just over 2.5 grams per ton. So we're thinking if we have anything over that, it would certainly be a go, because they're making a lot of money on 2.5 grams palladium underground. So that's our hope. And just to go back on the exploration potential, when Marathon PGM had it, and then Stillwater took them over in 2010, Stillwater did about, I think my number is around 15,000 meters of drilling. So this project hasn't been explored basically in 10 years since we took it over. So I think we've done about 25,000 meters, and we're just scratching the surface here. The previous operators hadn't drilled below 400 meters. And I'm sure most of you in mining know that there's a lot of underground deposits that don't even start until 1,000 meters. And, we've only started to drill a couple deep holes, and we're going to continue to drill it. And there's that possibility, to find that holy grail, or that massive sulfides feeder zone, as Kerry was mentioning earlier on. So there's newer technologies, and we're just, getting into that right now. So we're, it's going to be a two-prong approach, obviously building the mine, but at the same point in time, we want to keep the exploration going as well.
Right. Moving to the next question. What timeline and key performance targets have been set by the company?
So as we pointed out here, our timeline is to get our permits next year, hopefully in the first half of the year, to do the detailed engineering and the mine financing through the rest of this year and into the next year. And then hopefully about middle of next year to start construction of the mine. And it's about an 18-month construction period. So at the very end of 2023, we're hoping to turn on the mill, break it in. It's usually a 6 to 8 month break-in period, and then we would be in full production towards the end of 2024. And by the way, I should add that will make us the next new palladium mine in the world. There's nobody that can come close to that timeline.
Sounds amazing. Yeah, so the next question is, could you please comment on your funding strategy?
Sure. We, as you know, we need $665 million in capital costs, and we're going to need working capital and a few other things as well. So the total number, these are Canadian dollars. So the total number we're going to need is about 800 million Canadian dollars, and that's about 600 million US. So our plan is to, and we're in deep discussions with several banks right now, streaming companies, private equity companies, smelters. There's lots and lots of different sources of financing. It used to be that you had debt and equity. That was all you had to look at. Now we've got streaming, royalties. So we're looking at, now this is if Sibanye walks away from this project. If Sibanye is going to be involved in this project, they're going to be putting up most of the money, because they have to put in over $200 million just to back in. So we're going to be carried for most of that, and the rest of the capital costs are mostly going to be debt. But let's say they walk away, which is kind of our hope, because if they walk away, then we'll own the whole mine, and we will look at doing about 60% debt and about 30% streaming. There's lots of streaming companies that made us offers. We're confident that we can get about 30% of the cost we need from streaming. There are some smelters, etc., that have offered us some debt as well, some secondary debt that could go beyond the first debt, and then we'll have to do some equity at some point. But the equity we're trying to keep as small as possible, and we think that we might be able to keep that somewhere in the $50 to $100 million range.
And just to follow up, I don't know if the question was in the future, but right now we have just under, I believe, 11 million in cash in the bank. And then we have some warrants in the money. That's another couple $1 million that are coming in by July. And then we have about another 5 million in warrants that are coming in, hopefully by the end of 2021. So we're pretty good funding until, at least the fourth quarter of 2021. So just depends on what, as Kerry mentioned, what happens with Sibanye. But right now we're pretty good on cash.
Right. And the next question is actually a little bit related to what Kerry has already covered in the previous question. So what are the transaction terms with Sibanye and how is it involved into the project development?
So the deal with Sibanye when we bought this project from them was that they were going to keep 20%. And once we did a feasibility study and made a production decision, they had 90 days to decide whether they want to buy back 31%, which would give them 51% of the mine. The cost of that was going to be 31% of the capital cost, which is 206 million Canadian dollars. So they have 90 days from the clock started ticking in April. They have 90 days up until July 21st or 22nd to make that decision. So they can do one of three things. They can decide to buy our whole company. They can decide that they're going to back in and write that check for a couple $100 million and own 51% of it, and we'll own 49% of it. That means they have to spend the next $200 million. So we'll be carried for probably 18 months. And the third one is they can decide that they don't like the property and they can walk away from it. And if they walk away from it, we will either buy or arrange for someone else to buy their 20%, and we'll move ahead towards production. So that's the deal. We're expecting an answer from them, by the way, in June over the next month. And the reason for that is they've told us that they're not going to wait until the very last day. As soon as they make a decision, they're going to let us know. But we really do not know what they're planning. We think on the one hand that this is small for them because they're a 13 or 14 billion dollar company. But on the other hand, it's very profitable. So we're not sure what they're going to do. Go ahead, Jamie. Sorry.
No, I was just going to say there's been some precedents of a couple companies of recent. There's Skeena, I think it's Skeena Metals or Skeena Minerals. Barrick had a back-end rate. They elected not to participate. They converted their back-end rate into like 19.9% ownership. They took a board seat. I think the stock doubled on that news. I know Agnico did it with another junior recently. Bristol or something was the name of it, where they didn't participate on their sort of ownership, and then they're getting shares as well of this new company. So it's happened a few times where the majors don't want to build a mine, so they'll keep a toehold in there by just keeping a 19.9% equity. So that's another option if they elect not to participate.
Okay, thank you. And the next question is about electric vehicles. So the green economy is driving the transformation of the automotive industry towards the mass production of electric vehicles. You have already shared your view on that, but just wondering what are the uses of palladium other than the converters?
So palladium is used in, as you know, in converters. It's also used heavily in the chemical business. It used to be heavily used in the jewelry business, but it got too expensive. And now people are buying platinum jewelry and they used to, when people bought white gold, what they called white gold before, it had a high palladium content, a lot of it. So therefore, a lot of it was used in jewelry. There's a couple of other things though going forward. One is if the world does turn to electric cars, and if they do turn to fuel cells, right now a typical fuel cell needs at least 1 ounce of platinum. But there's only 6 million ounces of platinum mined every year in the world. So and there's 90 million cars sold. So like there's not enough platinum to switch to fuel cells. So you can use palladium in place of platinum in fuel cells. So that's if the world turns to the fuel cell, which Honda's doing it, Toyota's doing it, GM is doing it. If hydrogen fuel cells get popular, they're going to need all the palladium and platinum they can get. And the difference is they actually need a little more palladium, and they have to mix it with silver to make it do the same thing as platinum. So there's lots of uses for it. But if it all, for whatever reason, fuel cells don't catch on, and people stop using gasoline suddenly, which I can't see happening for many years. But if it does happen, we've got a pretty good copper production out of this, and copper will be in hugely short supply if electric cars get popular. There's not enough copper planned in this world to make the whole world go to electric cars. There's not enough nickel or lithium either. But
well, thank you for answering that question. Unless our participants have a question that they can ask right now, I think we can stop here. So thank you very much, Kerry and Jamie, for joining this live webinar. I really enjoyed that. I hopefully our participants too. And to all our attendees, please share your feedback. Your opinion really matters to us, what you think about the company. And stay tuned for the next webinars. Thank you very much. Jamie and Kerry, good night.
And I just want to say, go to our website, sign up, follow us. We got lots of news coming out over the summer. So if you want to follow us, just go to our website and sign up.
Thank you very much, and have a great day to all of the people who joined from this part of the world. And good night, Jamie and Kerry.
Okay, and thank you, Adina and Fortune, for all your help.
Thank you.
Bye-bye.
Bye.